it has very, very big implications. And of course, the most important factor is as the result of the Fed tapering, is that we expect US Treasury yields, 10-year Treasuries, to get to around 2% by the end of this year, beginning of next year. What that would do to the market, of course, we've already, as you described, what the market has been doing recently. We are expecting change of leadership in the market. So we think value stocks would do better in this environment. We like financials as the biggest beneficiary of that. Cyclicals should do well. We are overweight industrials in this space. And we worry that higher nominal yields, but especially higher real yields, because this is how we think the nominals are going to go higher, with real yields doing most of the work. That means that traditional growth trades like tech, consumer discretionary, and the US as the market could be a little bit under pressure. So our positioning right now is pro-cyclical, pro-value, with some caution on growth stocks.
Very clear, a really nice outline there. Does that then mean that you have a preference for Europe and the UK over the US? I mean, given the over-indexation to cyclical value stocks.
Indeed. So within Europe, our preferred value trade is the UK. And in fact, globally, the UK is the biggest value trade you can play in the market. So we have an overweight there. Another overweight we have is Japan, which also does very well. It is a very cyclical market, and it tends to do very well in rising yields environment. So within Europe, overweight preference for the UK. Continental Europe is only neutral, and the US is neutral as well.
We've got earnings season kicking off this week. Midweek, we've got the U.S. financials starting things off. And if I look back at the last earnings season, it was really extraordinary how strong numbers were. We saw analysts across the board upgrade their earnings numbers. But now supply disruption seems to be the name of the game across sectors, rising inflationary pressures. What do you think we should expect as the key themes this earnings season? And should investors get involved in the cyclical value parts of the market you just described before earnings season? Or is this the kind of thing that we should wait for earnings to come through before taking positions?
In terms of waiting, I think the market prices in what's about to happen in the earnings season ahead. But in terms of what we look at from the earnings, and perhaps not this earnings season, but let's look 1 year ahead. We worry that after the spectacular year as we've had this year, so EPS growth globally this year is expected to go up by 48%. So it is phenomenal. For next year, the analysts are expecting slower growth of 8%, still okay. But what we worry is that earnings momentum, short-term earnings momentum, is starting to fade. We also start to see analysts' upgrades starting to fade away. And the biggest weakness for now we see in the parts of the stock market that is most exposed to the Chinese slowdown. So the emerging markets and Australia, from the regional perspective, have seen negative earnings momentum in the last 1 month, while the UK and Japan is still leading the way. While within the sectors, the negative earnings momentum you can see in the Chinese exposed sectors. So of course, mining is mostly affected, and another sector is consumer discretionary, and that's mostly via the European consumer discretionary stocks like autos or luxury goods. So we worry that actually risks are to the downside, Juliana.